Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Which again sets the stage with what's going on in Europe for global demand to fall off the cliffs again if some type of systemic risk were to come about. You saw them protesting in France today based on an increase. Sarkozy wants to increase the retirement age 2 years. So on that measure, there was a strike across the board in France. Austerity measures really haven't kicked in yet, and we're seeing some pretty nasty protests across Europe. That's one problem on the social front. The real 800-pound gorilla in the room is the European banking system, and we've thought this for a very long time. This is an interesting chart, and I talked to Steve about this morning, in fact, and we showed this in our issue. This comes from the International Economy magazine, and most people don't realize how big the European banking system is. This is the global banking system right here, the assets in the global banking system. And despite the fact that the U.S. is the world's largest economy, it represents, its assets for its banking institutions represent 13% of the globe. Fast forward to Europe here on this side, they represent 62% of the global economy, the assets in the European banking system. There's a massive amount of exposure in the European banking system in a very, very big way. The euro was formed to a degree to support and enhance the competitiveness of the European banking system. The European banking system drives an unordinate amount of GDP growth for the European economies. European banking system stress tests, which were talked about today in the Wall Street Journal, being just total public relations, which we had been saying that for a long time, are finally starting to hit. They hit a lot of, they were hiding a lot of very, very nasty bombs on the balance sheets here. There's massive exposure to not only the core countries in Europe, the pigs, but there's also massive exposure in the European banking system to all the periphery countries that they did a lot of lending to: Hungary, Czech Republic, Poland, Latvia, Estonia, even Ukraine and things like that. So these problems have not gone away despite the public relations out there, and it really is something that could tumble the world from a systemic risk. So it's number one that we're watching. We say we're on the fence from a macro global path because there are signs of some recovery in the world. So we haven't made up. But we're watching, and this is number one and what we're watching. The two charts you see here, and a way to evaluate some of the riskiness of the European banking system is watching the spreads. And these are the yield spreads here between, the top one is Greece versus German bond market. German 10-year bonds are kind of the standard to evaluate risk against other countries. So this is the 10-year bond spread of Greece above the German 10-year bonds. Right now, back to a new high, back above the crisis high we had before. So yield spreads are starting to blow out. The euro is down 191 right now, 191 ticks. And it's because of this risk right here, again, in the European banking system. Exposure, or thought of its exposure, finally coming to the fore again. The market's recognizing it. The second chart here is the spreads. Ireland above the German bunds, and you can see they're blowing out also. This is why the euro's gotten hit hard today, and we think it could be a real trigger again for some real systemic risk. U.S. stock market's down 107. As I said, the euro's down 200, flowing from this European banking system problem when somebody finally starts to challenge the stress test again. The macro path, really number two we're watching is the U.S. jobs market. We continue to be told that the U.S. jobs lag the global recovery. Well, they're still continuing to lag in a very, very big way. In past cycles, we've seen a much faster rebound in the U.S. job market. U.S. job market continues to look ugly. A little bit better news last month, but again, very, very behind schedule. And I think one of the reasons is that the policies from our government really are eating away at seed capital and really hurting the private sector and hurting small business, which really is the driver of jobs. Everything they've done seems to be targeted at really hurting those job-producing sectors. Sure, they've created some tax credits and junk like that, but it's ridiculous. Most small businesses don't even bother with trying to figure out and jump through all the hoops of tax credits. It takes the accountants too long to figure out all the rules and regulations. They can do a lot to really turn this around, but given their political outlook, they continue to run on these Keynesian policies, which are continuing to crush jobs in a world in a world where there's a chance of real secular deflation. It's very bad to have these sets of policies in place at this time, and they're flowing directly into suppressing the job market. Till we see this turn, we're not going to be comfortable that we're out of the woods and aren't slipping back into a double-dip recession. Number three, I guess, that we're looking at is Chinese real estate prices. Again, just a trigger. Not that it's game over for China on a secular basis in any way, but it's very possible a cyclical accident. We think it can be triggered from a decline in real estate prices as kind of the lead catalyst indicator. If you look at these real estate numbers, as a percentage of GDP, China now, their housing is approaching 3.5% of GDP, right where it was when the Japanese bubble peaked, at those type of valuations, the GDP numbers. We wrote a piece that was printed in the Forex Journal last month about the eerie similarities between Japan and China. And if you'd like to get a copy of that, please let us know. It's incredible. The policy path that China is going down very much matches Japan when its bubble broke. So it's one of the things we're watching as an indicator here, and you can see this, this exponential move on the chart here of land price valuations in Beijing. Often that's a sign getting close to the top when charts go exponential on anything. Three scenarios here going forward in the dollar. Really a simple way to look at this, and we try and keep it simple because it's so complicated out there if we try and pick up every fact and news item in the world. But one of the ways to look at this is think of the dollar as a smile. And we got this from Stephen Jen, who was at Morgan Stanley for many years as their currency analyst, and he was very, very good. He's since left to make his fortune at a private hedge fund. But he came up with this scenario and many years ago, and it still applies. On the left side of the dollar smile, the dollar appreciates on risk. And for us, the risk factors in the world, the risk events of the European banking, U.S. double-dip recession, and Chinese real estate, which could break the credit bubble to a large degree. So that's, a strong possibility here why the dollar could move up. It doesn't mean that the U.S. is doing anything good. And that's what's so perverse about the U.S. dollar because of its global reserve currency status. We keep thinking locally how ugly it is so the dollar can't rally. But it sure can and it will if we see these risk events play, any one of these risk events play out, we think the dollar rallies. U.S. double-dip recession, we think will trigger risk because we just don't think the world can continue to move in any way. We're not any believers in decoupling, and we haven't been in the past. At some point, we'll see the decoupling, but we just don't think the consumer depth is there in Asia yet to get a decoupling if the U.S. goes into another recession. So we're actually leaning towards this call, the dollar appreciating on risk here. Down the bottom of the smile here is the idea that the dollar falls and continues to fall or stays low as the U.S. economy muddles through and the Fed provides a dollar-based credit to the world for global growth, meaning the Fed keeps rates at zero. The U.S. goes along on this very under capacity or under par glide path of growth The U.S. has very low interest rates and low relative growth. That's bad for the dollar, but it could be good for the global economy in the fact that the U.S. dollar credit is being pumped out there by the Fed to keep asset markets alive and keep growth alive in the global world. That's driving some, especially the emerging markets that are driving above trend growth that are helping the world economy as the industrialized world economies suck wind here.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.